you mentioned in the book the fast lane approach to quickly filter the deals. What are some key red flags for venture capitalists look for reject the deals very quickly? What is the trick?
Yeah, fast lane is what really all smart VCs use. And first of all, let me mention, Burak, is that the reason they use fast lane is because they network so hard, they outsource so much, they look for deals so much that in fact they're fielding thousands and thousands of deals, and then they need to come up with just a small number of those deals to invest in. I show in my research that it's 100 to 1. You analyze 100 deals, you invest only in one. Okay, and you can't analyze 100 deals, hundreds of hours each. So therefore, there's a fast lane. And yes, a fast lane meaning you identify some red flags, and the moment you meet a founder or a startup, and some red flags are raised, you just pass on, you just move on to another deal. So what are the critical red flags, especially for early stage investors? First is the team. The founder, the co-founders, and the early team is the single most important factor for VCs to decide on whether to pass on the investment or whether to explore further and then potentially to make an investment decision. Now, what do they look into the team? What are the red flags? Now, sometimes it's untrustworthiness. So, for example, if the founder mentioned that they have already a great customer, and a quick reference call that might take 5 minutes yielded that, well, actually, this customer hasn't paid a penny, or even worse, has never heard about the founder. That's the end of the road. Other red flags is why you. So if you were come to me and says, I have this great idea, and I'd like you to give me $5 million. So why you? What is your unfair advantage? Or as VCs call it, founder to product or founder to market fit. And founders very quickly need to showcase this, or VCs will say, well, we'll move on even if idea is great. So those are some of the red flag related to teams. Now, the second red flag, I would say, for early stage VCs is about the market size. Now, in some cases, there's no really market to speak of, okay, because market doesn't yet exist. So then VCs will have to use some other red flags. But often enough, the market is there, market is growing, maybe, and you can define a market. Let's say in biotech, very often the market is pretty well defined. And if the market for some kind of for innovation of whatever founder is doing is small in the best case scenario, then the VCs will not be interested. They're not really interested in niche businesses. An important point here, caveat, is that obviously VCs are of different stripes. Some VCs are managing large funds, maybe 1 billion plus. Other VCs managing small funds, maybe 50 million and less. And obviously, the smaller the fund you're managing, the lower the required target market size is. So if you're a $1 billion fund and you invest in a niche market, you're very unlikely, even if the startup is going to be truly successful, you're extremely unlikely to make this startup your fund returner. But if it's a $50 million fund and maybe it's a relatively niche market, you still can be successful. By the way, it's important for founders. Founders, if you raise money from a VC, first of all, find out whether the fund that VC is investing from is a relatively small fund, is a relatively large fund. Find out what they think about the market size. So that is the second red flag.
What is the difference between asking why not to invest and why we invest in this opportunity? What are the different answers for these both questions?
That is a great question. And that, in fact, the single most important difference between fast lane and slow lane. In the slow lane, which is a typical due diligence, we're asking ourselves, why are we excited about this deal? Why we should invest? And therefore, we're answering a lot of questions along this line. In the fast lane, we're asking a question why we should not invest, and even more importantly, why we should not even proceed exploring this opportunity even further, okay? And it seems like a minor addition of a 3-letter word, not, N-O-T, okay? But it turns out, and there's been a lot of research by psychologists outside the venture space and even outside the finance space, that just by asking question differently completely changes the perspective. So, for example, if I'm going to ask you, Burak, to go out and find out why we should not invest in this project, the type of information that you are going to search is going to be different. You're going to be more negatively biased. You are going to pay more weight on negative information. You are going to be less optimistic. Okay. By the way, it's not always a good idea to be less optimistic, more pessimistic. But in this fast lane, that's typically is more efficient. So as a result of this, and that's important to know both for investors and for founders, that in the fast lane, which is typically when VCs approach this startup for the first time, before really they introduce the startup founders to their partners, they're using fast lane. And as a result of this, they're really trying to avoid spending more time with the founders. By the way, the founders, if a venture capitalist tells you, I would like you to meet with my partners, that really means that you're transitioning from the fast lane to the slow lane. Why is it the case? Because VCs have a lot at stake in the relationship with their partners, their time, their reputation, of course, the money. And as a result of that, it's kind of a big threshold for VCs to tell their partners, well, you know what, here's a startup founder. I spent 5 hours with him or whatever. Maybe my associate did this preliminary investment memo, but I would like all you to look at the investment memo. I would like all you to meet the team. So that means that they're going to likely spend more time on you. So founders, be aware, be cognizant of the fact that the transitioning from the fast lane to the slow lane also means changing the way your startup is going to be due diligence.